Everyone thinks to make money in the stock market, you have to buy a stock and then sell it for a higher price. But what if I told you that there's a way to make money on stocks without having to sell them? Well, in this video, I'm going to teach you that strategy, and it's called a covered call. Here's what a covered call looks like. I'm going to be going over how to use covered calls to generate income. Step by step, how to sell covered calls, when to do it, on what stocks, and all of the details that you should know about generating income. So what is a covered call? Well, first of all, you got to own 100 shares to do a covered call. It's called a covered call because it is covered, okay? And what that covered part is, it's basically having 100 shares and then selling a call option on those 100 shares to generate income. So here's like an image what this looks like. So if the stock goes anywhere above $200 before expiration, you agree to sell at 200 no matter what. But you get to pick what strike to sell a covered call at. So let's say you decide to, get Nvidia at 195. I know it's a little higher than that now, but if Nvidia is at 195 and you sell at 200 strike price, well, what happens is you have the stock, you have it, right? And then as it goes up, you make money, and then you stop right here, and that's it. That is no longer yours. That is someone else's. Now, that they may not exercise early. You may still get to keep this until expiration, but essentially everything above 200 where you sell that strike price, that is no longer yours anymore. And that's okay because you get paid via premium and you bought the stock for, say, 195. You keep premium no matter what happens, regardless if it goes up, if it goes sideways, if it goes down, that premium is yours no matter what. So this is why people love this strategy. I personally love it. This is how, like, literally bicep over tricep, money is made. You will scale, you will build wealth over time, and you actually hedge your portfolio. Like, this is safer than just owning stock in many cases, because if it ends up going down, there's risks, right? Stocks can go down, and when you do a covered call, you get income, so you get a little bit of cushion. By the way, real quick, my name's Henry. I worked at Goldman Sachs. I have experience at multiple different hedge funds, a degree in finance analytics. I say this so you understand that I know what I'm talking about, but I am not a financial advisor, so please do your own research. So if you have like 100 shares of any stock, well, you can sell a covered call and then you get paid. So the potential to get paid whether the market goes up, down, or sideways is amazing. Remember, nothing is guaranteed, so you can always make estimates based on the stock has done in the past, and you will lose money if the stock goes down, and it goes down more than the premium that you collected. However, when the stock market goes down or a stock goes down, everyone lost money anyways. So covered call actually protects you and you lose less money than others. So again, this is a good strategy. So you also want to use this based on a stock that you don't think is going to go above a certain price, because let's say that you do this on Nvidia, right? And then Nvidia goes from like 195 to $220 per share. If you sold a 200 strike, you are going to leave money on the table. So you don't necessarily want to do this on super bullish stocks, right? A covered call is a neutral bullish strategy. So you want to use this to generate income, but you don't want to sell covered calls that are too close to the money, because then you leave upside, right? You don't get all that upside. And we'll talk about that in a moment. We'll go over some examples. So here's how the covered call strategy basically works. It reduces cost basis on your holdings. And what do I mean by that? Well, it's actually really cool. If you own a stock that's moving sideways, you're theoretically lowering your cost every time you collect premium, right? So if you have a $100 stock, and I just thought of Walmart because I have a Walmart position in my portfolio, for example, let's go to Walmart. It's right at $101 per share. Every time I sell a covered call, it reduces the cost basis that I have. It might not show that in your account, but you can basically theoretically say, if I paid $100 for a stock and then I got $1 in income from a covered call this week, then your average cost is 99, and next week you got paid another dollar, it's 98, and then next week you got paid another dollar, then it's 97, right? You can reduce your average cost and it continues to go down. You're at 97. 150 more, you're at 95 and a half, right? That's essentially what's happened with me in Walmart. I have a pretty big position. I'm up $320,000 myself. And in my opinion, I think Walmart's a good company. It's very stable. So if you have a bigger portfolio, it's a great stock to play. It's just keeping it really simple, like covered calls on simple stocks. That's what I do. I do the research for you on my Monday and Wednesday call. If you're interested in that, it's the first link in the description. That is my job. I am literally looking for opportunities to sell covered calls majority of the time, or the wheel strategy. And I have a video on that as well. You can check it out in the description. But in the long term, the market's bullish. In the short term, nobody knows. If someone says they know, they're playing a fugazi on you. They're on some BS. They're just lying to you. So here's how it actually works. You buy 100 shares of a high quality stock. Please keep that in mind. Very, very, very important. Sell one call option contract per 100 shares. Choose a strike price above the current price, right? You want to give yourself some room. So, we'll talk about the example right now. If I bought Walmart right now at $101, I would honestly sell this position. Like you can see on my screen, this is still a good position to open up if you got the money for it. Essentially 105 covered call for March expiration, it's a good one to basically open up, in my opinion, right? So you collect premium cash up front, which is really nice as soon as you sell a covered call. The stock, if it stays below the strike price, cool. Basically the call expires worthless. You keep the entire premium. You still own shares, which is cool. Nothing happens. And then you just rinse and repeat next month, right? Number two, though, if the stock goes above the strike, your shares will get called away at the strike price. You keep all the premium collected, which is good, but you let go of the shares at the higher price. So that's fine, right? That's good. So usually you will profit on the shares, especially if you sell an out of the money covered call. Then basically the stock will go up, so you make money on the capital appreciation of the stock going up, and then you also make money with the premium that you collect. So let's talk about like a real example with some current prices. Looking at Apple, so Apple's at like 260. So look, I think Apple iPhone 17 came out recently. It's good, man. It's going to be making money. Everyone loves iPhone, right? So great brand. You buy 100 shares, $26,000, and then you sell a 270 covered call, 30 days out. I love monthly options. And then here you go. Here's the market price. And then here's 270, the call strike price, right? So essentially at 270, you're done, right? This red, that's someone else's money. That's someone else's tomato sauce. That's theirs. So hypothetically, let's say you collect $600. Well, if Apple stays below 270, cool. I mean, the 600 yours no matter what, right? So you got 600 and, well, it's below 270. So you got the shares, right? Let's say it just stays exactly the same. You get a 2.3% return in 30 days. Not crazy, decent, right? You can just sell another covered call. Now, if Apple goes above 270, well, the stock goes boom, then you're out at 270. So you made money from 270 to 260, made $1,000, you're done. Can't make more. 270, it's not yours no more, someone else's. But that's okay. Now you got a return of 6%, 6.2% to be exact. Now that is some good stuff. All right, let's talk about choosing your strike price. There are three main approaches that I personally follow that you can learn from. Number one is the conservative approach. This is lower premium collected, less likely to be called away, and you get to keep your shares for longer. And this happens by choosing an out of the money covered call. You go far out of the money, the farther it is, well, the lower premium, but the less chance of losing the stock. And if you really like the stock, but you want to generate income, then this is your best bet to go for a conservative covered call play. So when I say conservative, I mean conservative in terms of assignment risk. Your assignment risk is lower, the farther out you go. So if I go to like, trade Walmart options, the farther out I go for this position, you don't have to use Walmart. You can use any stock. You use Palantir and SoFi and Rigetti or whatever. You can go for, let's say I go for whatever, January expiration as this example. So if I go for 105, the 110 is going to have less premium, but it's also less chance of getting assigned. And you know that because the 105 here has a delta of 42, whereas the 110 has a delta of 27. So yeah, pretty big difference there. There's a 27% chance of it going to 110 and a 42% chance of it hitting 105. So that's a pretty big difference, and that's what I mean by conservative. And also focus on the stock appreciating. So if you have a bullish high momentum stock, you would want to use that. You can also go for like a moderate approach. So basically like kind of balance the premium. Go for like a reasonable assignment chance. That's like 30 delta. That's like my golden ratio anyways. And basically you have a good mix of income plus appreciation. Then you can also go for aggressive, which is like maximum premium, high assignment risk probability, which is going for like 40 delta or higher. You don't really care about capital appreciation as much. You just care about income and living a lifestyle in retirement, right? So you really want to focus on the best stocks that you are ready to sell. So if you made a lot of money and you're like, hey, I want an exit plan, high in the money or a high delta option will be exactly that. You can also see here on Palantir, the higher you go out of the money, the more safe. This is obviously a very, very old example to point out that I've been very, very early on Palantir. I've been so early, I bought it in the double digits a long time ago. So if you've been subscribed and you're OG on this channel, man, you made bicep over tricep money. You killed it. The higher you go, the less premium there is going to be. I took a little break. That's why I'm wearing a different shirt. But let's talk about Palantir and let's go over a real example right now. So it's actually a really interesting day because today is Q3 earnings of Palantir. We're in November. And what I want to show you, by the way, I have a pretty insane return here on Palantir. It's up at $200 already per share, so I'm up a crazy amount. It makes up 10% of my portfolio. But let's show you like what a covered call would look like on Palantir. When a stock has earnings and you sell a covered call, it's also important to understand that you probably don't want to go too close to the money because the options are going to explode. You can actually see here how a lot of these options are up a crazy amount in one day, like 40%, and that's obviously because the stock is up today and it has earnings. But you can see how a 3% move in the stock could impact the option by like 40%. So yeah, in terms of covered calls, it's not like a massive issue, but just again, give yourself room to breathe, right? So if we go back here to the presentation, if you were to sell a covered call on Palantir and it has earnings, go with the conservative approach so you don't end up regretting it later, right? So many people end up regretting. They're like, oh, I wish I would have done this differently. Well, okay, then go conservative, right? Versus other stocks like the Walmart example I showed you, you don't really have to be that conservative because the stock's not going to go up that much anyways, right? So that's the difference between like the conservative approach versus the moderate approach versus the aggressive approach. The aggressive approach, you'd probably want to use it on stocks that just really don't go up that much at all, right? So a stock that has low volatility that you don't mind basically getting rid of pretty soon. So that could be like Apple. Apple, it already had earnings, so it's probably not going to go up that much. It already had a big iPhone 17 release. So in the case of Apple, then you can go for more of that aggressive approach. All right, let's talk about timing your covered calls. So 30 to 45 days is really a sweet spot. I know a lot of people like doing monthly trading as well, and I think that's perfectly okay. When it comes to like weekly trading, it does make more money. It's a lot more management, but it's more money. So basically the time decay looks like this. In the last 1 week, it's going to be decaying very quickly. So if you sell an out of the money option, like it's going to be right here and it's going to go down to zero as long as the stock stays out of the money. Now, 30 days is still pretty good. You can collect meaningful income whether you go weekly or monthly, and you are flexible to adjust. Depending on the situation, I may go for a weekly option before earnings may happen, or if the stock doesn't have any earnings, no meaningful news coming up, I can go out for 1 month. So here's an example of NVIDIA, like a premium comparison. In 7 days, you will get like $250, but in 30 days, you'll get $900. So it's more attractive to go for 7 days, but for 30 days, you do get to lock in $900, and that's pretty nice because you get to have that premium today, and you can do something with that premium. Plus, it's locked in, right? So if NVIDIA goes down, you may not be able to even sell an option next week for that same strike price. You may have to go lower, and you may not get $250, right? So that's the benefit of locking in. You get something that's, for sure more money up front versus playing around with the 7-day option. If the stock pulls back, you will not be able to get this premium like 4 times, right? This assumes the stock stays the same, the volatility stays the same. You know how crazy trading is in general. Like even the safest stocks, they obviously move. SPY is very diversified and it still moves as well, right? That's why I like 30 days. But yeah, it depends on your risk tolerance. A lot of people like this weekly trading and it's more fun for them. I prefer 30 days. Some people even do 60 days, but you can see how it does drop off pretty significantly. Like this is an example, but $1,100 in 60 days, that's like double the time for only 200 extra bucks. So this would not make sense, right? So that's why like 30 days is really my sweet spot, up to 45 days. Here's some of like the benefits again. So smaller premiums per contract, but you can potentially do it 4 times per month for that same amount of money, more or less. It'll vary depending on the fluctuation of the stock. It definitely takes more work, so I do not recommend it for busy professionals. I got a lot of students that I worked with, hands-on, business guys, engineers, IT professionals, software, hardware, doctor, dentist, lawyer, pilot, you name it. And if you're busy, I don't think weekly makes sense. Just go for like monthly, in my opinion. It's better. Weekly is more active management, whereas monthly is just, you get a larger lump sum of money, larger premium, just set it and forget it, low management, and less time commitment. So you get to, work, job or career, and just keep going. And in terms of position management, this is a really important part of this covered call mini series. So position management, when a stock stays below the strike price, you don't really got to do anything. Really what happens is the option just expires worthless on a Friday. Premium is 100% yours. The shares stay in your account and it's ready for the next trade. So you can just do another covered call right away. So yeah, you can just take immediate action once it expires. So you just start the process all over again. You can just buy 100 shares of a stock and then sell covered calls. So that's pretty much it. Especially if it goes above the strike price, you'll be right here, right? So again, going back to this example, the $195, stock that you have at market price, if it goes to 200, if the stock is anywhere in this area at expiration, like those shares are gone. And that's what you basically get paid to take on the risk to lose your shares. It's a win-win situation. In my opinion, it's a win-win because you get paid no matter what, and then you let go of your stock at 200, which is higher than your market price here. That's a win-win for me. Now, I wanted to talk a little bit about rolling covered calls. So what is rolling and what is this topic of rolling? I'll have a link for you at the end of this video for a video that you must watch on rolling, but I want to go into it simply right now and explain it. So rolling is when you buy back your current call option. So if the stock goes above your strike price, rolling means that you buy it back, right? And then you open up a new one. So you sell a new call simultaneously. You buy one and then you sell another, okay? And it's usually for a higher strike price or a later date, or both, right? It's usually both. So usually move up and out. That's what I like to do myself all the time, is rolling up and out. You collect an additional credit. You can see here how this is also a pretty old example of American Airlines. I've been trading it a lot. You can move it up and out. So you can close out the 13 and sell, for example, 14, and just add some time to it. When would you want to roll though? So what are the basic rules of rolling? Well, really 3 to 5 days until expiration. So you pretty much know, okay, I'm in the money here, I want to roll it, and that's a good decision to make. If the stock is at or above your strike price especially, or if you just want to keep the shares, you don't want to lose them, so you just kind of roll up the shares. So you roll it up for a premium. Let's say you have a current situation, going back to NVIDIA, you own it at 185, you sold 190 call for 800, and now NVIDIA is in the money, it's at 193. Okay, so just, again, look at this, pause if you have to, take notes. But the stock went to 193, you're in the money, and you got 5 days left. And now the calls are worth $450, okay? So you actually made some money on the covered call, and you're up on the stock, but you still got 50 here, and you don't know what to do because it will get assigned. Well, the good news is you've made money in this situation two ways. You made money on the stock, and now since you sold it for 800, now it's worth 450, you can just buy it back. Or you can just roll it. So you can buy back the 190 call that you sold for 450 and sell a next month 200 call, which is a lot higher. The 200 strike is obviously $10 higher than the 190. So you can roll from 190 to 200. You can buy it for 450 and sell for 700. So now, you got a whole win-win here. You moving up plus you're spending 450, collecting 700. So now you have more profits in terms of the premium that you collect, the difference here, which is going to be $250. And then you also are moving up from 190 to 200. So you have a net additional credit of 250, and you gave the stock breathing room until 200 now. So now you've collected 250 more, and you've collected 800 already. So now you've just made $1,050. So really good stuff. And in terms of when you should take profit, don't get greedy. Please don't get greedy. Covered calls are a really simple strategy. The rule is if you made 50% in a short amount of time, you just take profit. So if a call is sold for 800 and now it's worth 400 after a short amount of time, let's say 2 weeks, you can take profit. You can also hold until expiration. Both of those are not greedy. Greedy is when you start rolling it a lot and trying to get closer and closer to the current price. That's more so greedy. So you don't need to roll it too hard. You can take profit if you get $400 in 1 week. In 2 weeks, it doesn't really matter, right? But up to 2 weeks, 400 would be like the halfway mark, right? So if you've captured 50% of max profit in a short amount of time, you can take profit and sell another covered call. So nothing is wrong with closing it out early, but usually I don't. So at the same time, if you feel like the stock will not go up anymore, yeah, you can just maybe keep your position, because it's going to depend on how you feel about the stock and where it is trading at in terms of the technical analysis. So more on that potentially in another video on technical analysis. So building your portfolio. So diversification is key. Obviously having a whole bunch of stocks, not all of these I like. This is just a picture I found online, but this is just an example, just an image. You definitely want 10 stocks to do covered calls on. Absolutely, it's very important to have 10 stocks. Different sectors, of course, so you want a combination of whether it's energy or industrials or technology or consumer discretionary, consumer staples. There's lots of different sectors that you want to be in. You want to definitely mix volatility levels. You want to have some stable stocks, some more aggressive stocks. For example, my portfolio, this is some time ago, a few months now, but I still basically trade the same stocks pretty much all the time. I get gains all the time. I was in NVIDIA here. You can see I was selling some put options here on NVIDIA at 152. At SoFi when it was 18. There's a lot of puts here. I had a $9 covered call at ACHR. Obviously, a lot of this did well. I was trying to get into Robinhood when it was 90. So I was doing pretty well. This is one of the reasons you should join my community. I've consistently been right for many, many years to grow my portfolio to 7 figures. So a lot of success here over time. But yes, so you want to do covered calls. So funny enough, there's not that many covered calls here except for the ACHR trade. Now, position sizing again, 10% is the rule. Don't go too much over 10% unless you have a high conviction in the stock, like it's NVIDIA, then that's fine. I usually do 10% in most stocks, unless again, it's one of my favorite stocks, then that's fine. Obviously, you don't want to put all your eggs in one basket, so you need 10 stocks. Even if you're really certain on a stock, it's usually not a good idea to have like all your money in one stock, obviously. So no one can predict any stock or predict the market. It's not even possible. Not even Warren Buffett or Miss Kathy Wood. They just can't. So if one bad situation happens, that you don't really have a huge issue. And yeah, 100 shares minimum to do a covered call. Like, you just need 100 shares. Otherwise, you can't sell a covered call. Like Microsoft, you need 52K, which is a lot. So sometimes you want to go over some smaller stocks. Something like an American Airlines, a Hims, Chipotle is beaten down a lot, so that's pretty easy. So let's talk about some mistakes. So one of the biggest mistakes is stock selection. So buying, the wrong stock. And the problem is you buy the stock just so you can make the premium on the stock, and then you get into trouble because it's just not a good stock. Company has bad fundamentals and you wouldn't normally own it, and now you're stuck in a losing position trying to make money. I've seen some other gurus on YouTube in their Discord community. They're just like going over MSTR and other stocks. They look good on YouTube and like, hey, follow me and this and that. We can collect a lot of premium here, and people are like, yeah, great, let me sign up, and then they get started, and then the person is chasing premium. Like, that's a red flag from someone that's coaching, or really any investor. Any mistake. It doesn't have to be a coach, it can be anyone. This is a mistake, going for the sexy stocks like MSTR, Mara, Riot. I mean, there's a lot of bad stocks out there that I don't trade, but this is just one example. You don't want to be in that. Obviously, GameStop, people were trading GameStop. I think people made a lot of money and then they lost a lot of money. Like, what's the point, man? Just be consistent, man. The fix is go for quality. Microsoft, SoFi, Apple, Nvidia. Good fundamentals, that's mandatory. It's like Warren Buffett said, like, if you had a punch card and you only had 10 punches and you can only make 10 investments in your life, you're gonna think pretty hard on what investments to make. It's gonna be pretty obvious, like, not to trade crap stocks. So yeah, fundamentals are like mandatory. It's like, why would you get married unless the person that you're marrying has all the qualities that you really want, right? So chasing like a bad stock for the premium is like getting married to a person just because like they're super attractive. Yeah, men do that all the time, but it's not really going to work out if you're marrying someone just because of looks, right? Not a good reason to marry them. That's a big commitment. So the same thing with like stocks. Like, please be logical here with your money, okay? Strikes are just too close. So sell calls at or just above your current price is going to be like just too close. Then you end up making income, but you don't end up making that much capital gains. So you're not really going to be beating the market. Definitely give yourself like 3 to 7% above your current price of the stock. That's really, really helpful. And then, yeah, just balance income with appreciation. It's a case-by-case basis. There's no way for me to give you like, hey, here's this rule for every single stock. That's why I have my coaching sessions. That's why I trade live. It's because every week I'm looking at something, potentially different, making a different play. Yes, a lot of the plays are similar, but a lot of the trades I'll make could vary based on the technical analysis, the fundamentals, the outlook, the earnings, the news, the management guidance. There's a lot to take into consideration, but usually the rule is pretty much target 3 to 7%. Obviously, big difference there in upside, right? I mean, 4% difference is wild, right? It doesn't seem like a lot until you think about it. It can end up being 5 to 6 figures of money for you in terms of like results. So yeah, it really matters. For very bumpy, unsure markets, when you need to sell aggressive covered calls to hedge, yeah, it can be important to go more aggressive in terms of higher delta so you can just collect more income. Especially in the bear market, covered calls are going to save you money. Yes, that's right, save you money versus just holding on to stock. Now, I wrote here ignoring tax implications. This is something that I'm definitely not going to cover on YouTube in great detail because, first of all, not only am I not a financial advisor, I'm also definitely not a tax advisor. So you should definitely seek a professional. For the most part, it's pretty simple. Taxes can impact you significantly. It's a very important factor in your investments. So when you buy stock, you sell calls immediately. Do you have to pay taxes once the position is closed and realized? Short-term capital gains tax can add up. It depends. And some of the fixes that you can have is just holding on to the stock for 1+ year when possible. Of course, if you're doing monthly trading, it's not that possible, but there are some strategies around it. I don't want to confuse anyone, but look into the tax side yourself or join the community and you can ask me more privately, not on the public YouTube setting. So number 4 is never rolling at all. Just like cranking out lots of profits. There's also a great benefit to rolling out and not leaving money on the table. Sometimes it can be difficult to get back into a stock. If it rises, you might have a psychological belief like, oh, this stock went up a lot. I don't really want to buy back into it. Mistakes can happen there. And that's pretty much it. Those are the mistakes that you don't want to make. So there you have it. Rolling is something that we discussed in this video that is extremely important. And I want you to check out this video right here on rolling, different positions, how to manage rolling, and the best practices for rolling. This video is absolutely mandatory for you to watch and learn more about rolling.